Hi everyone, welcome to week 4. For week 4, we're going to be focused on the role of monetary policy and the Fed. We're going to be reading chapters 11, 12, and 14. We're going to be looking at the role of money. And money is anything that's used as a set of assets that people that regularly can buy goods and services. There's 3 functions of money. Money is a medium of exchange, which allows people to exchange the goods and services they produce for money. Money is a standard of value, meaning it holds the value that's on the note, and it's a store of wealth, which means the money will, with the value it holds, creates a purchasing power. Money holds the value on the note. There's a couple different characteristics of money and properties of money. Money is both durable and portable, and we look at that. Durability means that money is very durable and can last. The portability is money is very easy to carry. The acceptability is money accepted everywhere for transactions, and the scarcity is there's not a lot of money available. There's 2 kinds of monies that we focus on: commodity money and fiat money. Commodity money is money that holds a physical value, like gold, silver, cattle. That's a commodity money. Fiat money is money without intrinsic value. That is money that is used because the government decrees that type of money. It's the money that we have in our pockets. When we look at our checking accounts, you'll notice that that's a type of money. It's near money. And banks look at these different transactions that they make and how people hold money in terms of what numbers they hold. When we look at measuring the money supply, we're going to look at both M1 and M2. M1 is focused on the most liquid of assets, where M2 is not have the most liquid of assets. When we look at M1, we're focused on things that you can give someone in a room that they're able to buy right now, goods and services. Now, when we look at M2, it's not as liquid, and people can't get things in M2. If you look at the trends in the money supply, you'll see there's been a very large growth in M2. You'll notice that growth in M2 is implied that much of the money that's been growing has been contained in the non-liquid part of our economy. Now, when we look at the demand for money is very important to monetary policy because it tells policymakers just how people are going to respond to changes in the money supply. When we look at the monetary authorities, or the Fed, they control the supply of money pretty well, and the demand is determined by those choices. But the demand for money is based on the quantity theory of exchange. When we look at the quantity theory of exchange, we're focused on how money and decisions are made based off the velocity. Now, there's reasons why people hold money, and there's 3 main reasons: transaction cost, speculative nature, and precautionary reasons. Those are the 3 reasons why people hold money or want to demand money. When we look at the demand for money, there's a lot of challenges we're going to be facing with the demand for money. We have to evaluate the opportunity cost of holding money. That's very important to know. When we look at the opportunity cost of holding money, you're looking at the interest rate. And the interest rate of borrowing money is very important to know. Now, let's look at this graph right here. We have money supply and money demand. We're in equilibrium right here. If we have an increase in the money demand, you'll notice that we go to this level right here. Our interest rates are this. If we have a decrease in the money supply, our new equilibrium is here, and our interest rates are here. If interest rates increase, that will cause consumers to want to borrow less money, and that means less spending will occur. However, if the money demand decreases, that'll cause interest rates to decrease, which will cause other factors as well. And one of the factors that will be caused by that is consumers will want to borrow money. Now, the reason why there's shifts in the money demand, the main reason is there's shifts because people want more money. People demand more money because of income. When there's changes in income, that's the reason why people will demand more money or demand less money. Now, when we look at the money supply, we're going to look at shifts in the money supply and figure out why the money supply shifts. And there's a couple different reasons why the money supply shifts. If you notice the increase in the money supply right here, you'll notice that interest rates decrease on this example. So an increase in the money supply, more money being injected in the economy causes lower interest rates. Now, when interest rates are lower, that will cause aggregate demand to increase. So that's key to note. Interest rates decrease, aggregate demand will increase because consumers, businesses, and government will make decisions in terms of the lower interest rates to borrow more money. Now we look at chapter 12, we're looking at how banks create money. Banks create money based off of the fractional reserve system. So fractional reserve system looks at the supply of money in the economy and the amount of money that's available in circulation. When we look at a balance sheet of a bank, you want to look at assets and liabilities. When we look at it, you have to note that assets and liabilities have to be equal to each other. That's very important to note when we focus on this. Because when we look at what is liquid, you'll notice this stuff right here, checkable deposits, that's money that's been deposited in the bank. Loans from the Fed, these are all, these are things that the bank will own or owe later on. These are the things that banks own right here, these assets right here. And you'll notice that assets need to equal liabilities. That's very important to note. Now, banks can expand loans as long as it has excess reserves. The banking system as a whole can expand loans as long as there are excess reserves in the system. Whenever you have expansion in the money supply, it must stop only where there are no more excess reserves. So you get rid of these excess reserves when banks lend them. Banks want to lend money out when there's opportunities. Banks will not always lend money out when they find that opportunities are not at the best time. And that best time occurs a lot of times when they feel very scared about the fluctuations in our economy. One of the tools that the Fed has is called the required reserve ratio. The required reserve ratio is the amount of money that a bank is required to hold. When we look at the amount of money a bank is required to hold, you'll notice that a bank is required to hold, on average, 10%, the Fed decides. When they have to hold 10%, that means that they cannot make any more decisions in terms of lending greater than 10%. So if someone deposits $50,000 in the bank, they're required to hold $5,000 in the bank and not lend out. That's a little bit of security reasons as well. Now, why expansion might be less than the maximum? If you look at it, banks are not required to lend the money out. So banks aren't as likely to lend money out. And when they're not as likely to lend money out, you'll note that expansion might not be as great as it could be. Expansion is a very important aspect that we need to focus on. Banks may choose to hold more reserves than are legally required, which is fine, but it creates a lot of challenges because if banks don't want to hold as much money, or if they want to save more money, the public might not have the ability to get as much money from the banks. Now, when we look at the central bank, you'll notice that the central bank, or the Fed, is the main banking system, or it's the banker's bank for the economy. You'll notice that the Fed is the first to regulate banks. They're the lender of last resorts, and they manage the money supply to help economic growth. Those are three main factors that the Fed is focused on. You'll notice whenever we have bank panics and liquidity, bank panics are a sudden wave of fears that banks are not able to pay off their debtors. And when this occurs, banks are going to be very tight with regard to their spending and lending. And what happens is these challenges that they're facing, these challenges will create a lot of issues. And these issues that they're facing is how can they create a system where people want to be able to lend money at a safe and reasonable amount. The national banking system, it's banks that receive charters. And these banks that receive charters are very important. And they're very important because a state bank is chartered and regulated by many of the states. Comptroller of the currency in the Department of the Treasuries. There, they established the National Banking Act, and it did not substantially improve the stability of banks as well. You notice that when we look at bank safety is very important. You don't want to have a run on the banks. And when you don't have a run on the banks, when banks are able to function, people will not run to take money out. That's very important to focus on. When we look at the Great Depression, you'll notice that we were set in a lot of big bank failures. And when there's a lot of big bank failures, this creates a lot of instability in our economy. So those are some of the policies that you're going to be focused on. If you need additional resources or help, please let me know, as I'd be more than willing to advise, but I look forward to your effort this week.